What's up, fellow dentalpreneurs? If you're hearing my voice right now, I know you're a fan of audio and podcasts. But if you're looking for great video content, make sure to check out the new and improved Dental Success TV on YouTube. Videos from private member events, live talks from large and small stages, and lots more. Also, make sure to go over to our Dental Success Institute private Facebook group and interact with our community. You can also find me on Instagram at Dr. Mark Costas. See you on the socials. This episode is being brought to you by our good friends over at DDS Lab. Since 2005, DDS Lab has been dedicated to an unparalleled commitment to service. The DDS Lab team works closely with their lab partners to provide a tailored experience. Whether you know exactly what you need or are seeking advice on a complex case, training and educational services, or a friendly partner, DDS Lab is here for you. They understand that healthy smiles make a difference in patients' lives, and they're passionate about providing the best possible outcomes. On a personal note, DDS has been my lab of choice for 3 years now, and I'm more than satisfied with their pricing, quality fabrication, and prompt turnaround time. For more information or to request a starter kit, just go to ddslab.com. That's ddslab.com or call them at 877-337-7800.
The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone, and welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. All right, guys, this episode is being brought to you by the 9th Annual Dental Success Summit, which is coming up very, very quickly, June 10th and 11th at the beautiful JW Marriott in Desert Ridge, Arizona, my favorite hotel in all of Arizona. And there are a lot of hotels in Arizona. We would love to have you guys there. As always, we're going to have a very cool keynote speaker, another professional athlete. I'm going to be keeping that one under wraps until we get a little bit closer. But some of the best speakers in the dental profession, as always, will be gracing the stage. We'll be talking about high-level tactical things like systemization, maintaining a great culture within your dental office, how to increase your take-home income, how to decrease overhead, and how to scale, how to increase capacity within a single practice, or how to build multiples and get into the group practice / DSO type model. So we would love to have you guys there. Right now, this is just a save the date, the June 10th and 11th of June this year. Soon to follow more details and a registration link. All right, today, I'm very excited. This is a two-time guest. He was on a couple of years ago. We just figured out. And we today are going to be talking about dental practice sales from a DSO perspective, valuations, and a lot of cool things. He brings a lot of experience in this particular topic. So today I want to welcome Brannon Moncrief. He has 20 years of experience in the dental industry as a banker, broker, and M&A advisor. He is the principal at McLaren & Associates, which is an industry leader in dental practice sales and a sell-side advisory for DSO transactions. Welcome to the podcast, Brandon. How are you doing today, my friend?
Doing great. Thanks for having me.
Yeah, good to have you. So how's Austin, Texas these days?
Austin's crazy. As we were talking about just a minute ago, it seems like it's the who's who that's moving here right now from all over the country. And I feel like people think the streets are paved in gold. Everything's booming. So it's been a wild time to be here over the past 10 years.
Yeah, it is crazy. And a lot of the people are coming from, the high tax states like New York and particularly California. I know a ton of people that are in the influencer space and authors and podcasters and comedians like Joe Rogan who are moving there and bringing a flock of people with them. Even my good friend, or not my good friend, but a friend of mine who is a physician and has a podcast ended up there because he is connected with a lot of other podcasts who have podcasters who have moved there as well. How do the locals feel about this influx of Californians?
The old school locals are certainly not too happy about it. I've only been here 10 years, so I wouldn't count myself in that group.
Okay.
So it's been interesting to see it evolve, and hey, like everything, it always changes.
Yeah, for sure. I know that, I live in kind of rural Arizona, and we are neighbors. We share a border with California. So we get a lot of Californians, particularly people that are trying to get away from the high taxation and the crowding and the homelessness and the political environment in California have kind of trickled over to Arizona because it's a very quick drive, and a lot of people from California are ending up here, and a lot of the Arizonans aren't, especially the natives, aren't loving it, particularly when they bring their, for better or for worse, when they bring their politics with them.
Sure, we certainly have that current, but it's interesting. It's almost like a wealthy American refugee situation. I mean, it's a strange migration that's happening right now because of all the things that you mentioned.
Yeah, for sure. Well, I'm really, really glad to have you on the podcast today, because there's a lot of things that we could talk about. Particularly, I would love to get your take on the state of dental practice sales, the state of the union, I guess. What are some of the trends that you're seeing? And it wasn't that long ago, and you've been in the industry this long, that there was a lot of white hot money from Wall Street pouring into dentistry. The valuations were high. Money was flying fast and loose, and things have tightened down a little bit, particularly after the pandemic, but still a lot of transactions happening. So I'd love to get your take on what has happened in comparison to when things were kind of the Wild West and crazy with 18 times valuations and all that crazy stuff.
Yeah, absolutely. The world certainly changed since the last time we talked. I'll break it down into kind of two categories. We'll talk about doctor-to-doctor transactions, and then we can talk about DSO transactions.
Awesome.
From a doctor-to-doctor perspective, not that much has changed. I mean, practice valuations have remained relatively steady. I will say that the valuations for larger practices in the doctor-to-doctor world have increased, primarily driven by the fact that those practices are selling for a premium in the DSO world. So if I've got a practice with $1 million in revenue or more, my expectations as to what I'm going to receive for that practice have escalated. The biggest change we've seen is that practices with revenue under $500,000 with limited cash flow have become increasingly difficult to sell. Because of the rising student loan debt, as well as the younger generation's expectations from an income and lifestyle perspective, they either have to chase or want to chase larger practices. Mm-hmm. They need more cash flow. Mm-hmm. Otherwise, they can start a practice from scratch, which is difficult, an uphill battle, but economically potentially congruent to buying, a small practice with limited cash flow.
Right.
So that's probably the biggest two changes we've seen, is an escalation in valuations on larger practices in the private buyer world, and a lack of marketability on the smaller practices. Outside of that, we still have a healthy amount of sellers coming to market looking to sell to a private buyer. Mm-hmm. And we've got a healthy amount of buyers. I would say it's still a seller's market in the sense that we have, 3, 4, 5 qualified buyers for every strong practice we take to market in the private buyer world.
Nice. Okay. I'm curious, is there a significant difference in the way that you guys evaluate practices when you're looking at a doctor-to-doctor versus a doctor-to private equity and DSO? And if there is, you're shaking your head yes. If there is, can you walk us through that, the differences in how you guys evaluate those types of practices?
Yeah, absolutely. It is a different approach. I will say for larger practices, multi-million-dollar practices, oftentimes will give our client, the seller, the private buyer valuation and the DSO valuation so they can compare the two and make a informed decision as to what route they want to pursue. So here's the breakdown of the difference. In the doctor-to-doctor transaction world, buyers typically look at practices from two different perspectives as far as benchmarks go. So typically they're looking at a percentage of revenue. So let's call it anywhere from 70 to 90% of annual revenue. That's just an easy benchmark that a lot of buyers and advisors apply in the private buyer world. I would say a more accurate benchmark would be to look at net cash flow. So revenue minus overhead before the doctor is paid, how much cash is that practice throwing off? And multiplying that by a multiple of 1.5 to 2 times. I would say that's a better way to gauge value because two practices next door to each other, each with $1.5 million in revenue, should not necessarily be worth the same amount of money. If one practice nets $750 and the other only nets $300, I'd much rather buy the practice that nets $750. So when you look at it from a percentage of revenue standpoint, a lot of the truly impactful elements get lost, in translation by using that simple of a benchmark. From a DSO perspective, we're looking at predominantly EBITDA. So earnings before interest, taxes, depreciation, amortization. So we're looking at revenue minus overhead minus doctor compensation gives you EBITDA. And most DSO buyers pay a multiple of the EBITDA of the practice. Now, what multiple they're going to pay is going to depend on multiple factors. It's going to depend on geography. It's going to depend on the type of practice. Is it general? Is it specialty? Is it multi-doctor? Is it single doctor? It's going to depend on the size of the practice. Typically, the higher the EBITDA, the higher the multiple. And several other factors, location, facility, type of patient base, type of dentistry, all those things influence where the multiple is going to fall. We're typically seeing practices with EBITDA under $1 million trade in the 5 to 6.5 times EBITDA range. Practices over $1 million trading in the 6 to 8 times EBITDA range, and then large multi-location practices, platform investments, as private equity and DSOs call them, could trade for as high as 9 to 10x. The biggest change we saw post-COVID, and this was very interesting in the DSO world, is that, like you said, things tightened up for a while. Most DSOs were funded by private equity, which are funded by banks. And during COVID and for the first 6 to 12 months post-COVID, everybody was trying to figure out, is dentistry going to survive this? Or, how bad are we going to get hurt? Are we going to thrive? What does the future look like? And it was relatively uncertain. So banks tightened up, DSOs tightened up, not only on their valuation, but many of them put their business development efforts on pause. And they basically, went dormant for 6 to 12 months. So when you're backed by private equity, you're typically on a 5 to 7 year window where you need to consolidate, build up the company, and then sell it to the next investor. So the private equity firm can cash out and give the return back to the investors that they're serving. Well, when you put everything on hold for a year and you're in a 5-year window, you have no choice but to play catch up. Once you open back up, your lenders open back up, and it's time to start doing business development again. So COVID created this really interesting situation where for a while, valuations were depressed and some companies weren't buying practices at all. But once the market opened back up, the buyer demand skyrocketed and valuations increased as a result. So we're seeing practices that would have traded for, 5x pre-COVID, now trading for 6.5x post-COVID. And once valuations go up in that world, they tend not to decline. From the perspective of, the modest size practice owner selling to, a larger entity. So we haven't really seen a pullback in valuations. We've actually seen valuations increase in the DSO world substantially over the past, I'll call it 18 months.
Interesting. Thank you. That was a very, very concise explanation of what's happening right now. I'm curious, when you compare the doctor-to-doctor kind of valuation methods to the DSO valuation methods, I'm interested to differentiate the two. Okay. So you said roughly, for the doctor to doctor, we're looking at net cash flow, and you're including in net cash flow doctor compensation, right? So, for the doctor to doctor, for instance, let's just say, just for round numbers, let's say it's $1 million gross revenue practice. Okay. So it's bringing in $1 million. Let's say they run a pretty tight ship. So fixed and variable expenses run, 30%. Okay. So you're looking at, that being the overhead, and then say doctor compensation is 30%. So you have 300,000 of that $1 million is going to fixed and variable expenses. Then you have another 300,000 ish that's going to doctor compensation. What you have left is 400,000. What you're saying is a fair valuation on this particular practice would be 1.5 to 2 times that 400,000. Is my math right?
So in the doctor to doctor world, slightly different. So, okay. and 300,000 in overhead on $1 million practice would be extremely low. We would typically see it more so in the 600,000 range.
But that's including doctor compensation, though.
No,
not including doctor compensation.
We see that the average. Let's just talk general dentistry. We see that the average general dentistry practice, the overhead's running but before doctor comp, somewhere around 60 to 65%.
Yep. And so that would be, you're right. That would be 600,000, not 300,000. I was basing that on what we would call our black belt level practice, which is 50% overhead if you're excluding the doctor compensation.
Right. I wish everybody was running at 50% overhead, but we see most people running at 60 to 65% overhead.
Okay.
Now that's in a practice with revenue of, let's call it $1 million, $1.2 million, somewhere around there.
Okay.
So let's say that practice is doing $1 million in revenue, and let's say overhead 600,000. From a private buyer perspective, net cash flow is 400,000. Mm-hmm. We apply that 1.5 to 2 times multiple to that 400,000. Gotcha. So, that practice would be worth, somewhere in the range of, 6 to 800,000 is where we would expect that practice to trade. Where it's going to trade on that range is going to depend on a number of other factors, location, quality of facility, type of dentistry, type of patient base. All those things go into where you're going to trade on that multiple.
Yep. Awesome. And then if we're going to hop over to the DSO model, that you throw the doctor compensation into there. So
Correct.
Say it's 30%. And Correct. Then the net you multiply by 5 to 8 times that.
Right.
Number.
So let's take that same $1 million practice.
Yep.
And it's got $600,000 in overhead. So there's 400,000 left over. And then doctor comp is going to be 30%, but there's going to be some hygiene in there, right? Mm-hmm. So let's say doctor comp is 200,000.
Okay.
So you have $200,000 left over. And on a practice that size, let's say you apply a 5x multiple. So that practice is going to trade for $1 million. So you see, even in a practice with modest revenue, $1 million practice, which that's successful, but there's some very, very big practices out there these days. Mm-hmm. So I'll refer to it as modest. But with $1 million in revenue, private buyer valuation in the 600,000 to 800,000 range, DSO valuation at $1 million, there's already a pretty significant delta between those two valuations. Mm-hmm. That delta increases exponentially as the practice grows. Mm-hmm. So once you get around $2 million in revenue, the DSO valuation begins to quickly run away from the private buyer valuation. And it's that delta in valuation is one of the big reasons that large practice owners are looking to go the DSO route as opposed to the private buyer route.
Awesome. Okay. This is great because you work with both. I love to kind of do side-by-side comparisons. So the benefit, as far as I can see, and I've had 16 practices and sold 12 myself. I've sold some to corporations and I've sold some to private buyers. There seems to be a lot less baggage when you sell to a single private buyer, right? Typically, they get traditional bank financing. There's not a whole lot of strings attached. You can stay if you want to stay, if the buying doctor wants you to stay. And there's no kind of performance requirement to get your full lump sum, right? And then if it's a DSO route, there seems to be a lot more strings attached. I wonder if you can kind of go back and forth and compare the difference between a doctor to doctor versus a DSO if you're selling, say, a single practice.
Yep. So that's a fantastic point. If we take that $1 million practice as the example, in a private buyer transaction, let's say it's going to sell for $800,000, and the private buyer is going to borrow 100%, financing, and give you 100% cash at close as the seller. So you're going to put $800,000 in your pocket.
Yep.
Typically very simple. There's not a lot of strings attached in a private buyer deal. In the DSO transaction, while your practice might be valued at $1 million, at close, you're going to put anywhere from $650,000 to $800,000 in your pocket. And then you're going to likely have to stay on for a certain period of time, call it 2 to 3 years. The practice is going to have to maintain its revenue level at the time of sale for that period of time in order for you to receive that premium in cash. So that's the primary difference between those two types of transactions. And for a lot of doctors with that size practice, it's not worth it to sell to a DSO to get a little bit less money cash at close and have all those strings attached. It's really situational. Now, if I'm a one doctor practice and I'm in a situation where I don't really want to run the practice or manage it anymore, and I want to take some chips off the table and de-risk, but I want to stay on post-close. I'm not ready to retire. And that's the position that a lot of baby boomers are in. They're either not financially or emotionally ready to retire, but they don't really like dealing with the management of the practice. Well, if I can get a premium for my practice and I can offload the management burden and then stay on for a few years until I am emotionally or financially ready to retire, then the DSO option starts to become more attractive in the scenario that we're talking about. Obviously, if we're talking about a practice with $5 million in revenue and $1.5 million in EBITDA, where the DSO valuation is going to be $10 million and the private buyer valuation is going to be $3 million, it becomes a much more compelling argument to go the DSO route. So it's very situational. And I will say that it becomes more compelling as the practice grows in size.
And that wraps it up for part 1 of my interview with Brannon Moncrief. Make sure you guys tune in tomorrow for the conclusion. Have a great day. This episode is being brought to you by Large Practice Sales. Large Practice Sales helps doctors of all ages and specialties monetize a part of their practice with a silent partner. How does it work? National groups purchase between 51% to 90% of a practice for cash up front, and the doctor remains an owner leading their practice under their brand, team, and strategy. Doctors benefit from the resources of a larger partner to grow bigger, faster, and more profitably. Contact Large Practice Sales, or LPS, today to confidentially discover your practice's value in an IDSO partnership at no cost without obligation. Just call 844-976-5332. That's 844-976-5332. Or visit largepracticesales.com/dentalpreneur. And that wraps it up for another episode of the Dentalpreneur Podcast. Look forward to reconnecting on the next episode.
Thank you so much for joining us today on the Dentalpreneur Podcast. Check out TrueDentalSuccess.com for full recaps of every show, a schedule of our live events, free video tutorials, and a whole host of practice building resources.
What's up, fellow dentalpreneurs? If you're hearing my voice right now, I know you're a fan of audio and podcasts. But if you're looking for great video content, make sure to check out the new and improved Dental Success TV on YouTube. Videos from private member events, live talks from large and small stages, and lots more. Also, make sure to go over to our Dental Success Institute private Facebook group and interact with our community. You can also find me on Instagram at Dr. Mark Costas. See you on the socials. This episode is being brought to you by our great friends over at Profi 2020. Profi is a full-service dental CPA firm that provides bookkeeping services, monthly financial reports, managerial accounting services, and proactive tax service to growth-oriented dentists around the country. Profi was born in a dental practice out of their owner's frustrations with the dental accounting industry. Chris Sands actually managed a dental practice early in his career, learning the business from the ground up. During that time, he found that it was nearly impossible to get thorough financial reporting for the practice, and even more difficult to get any kind of proactive guidance. That's when he and his business partner, CPA Brent Sonnier, decided to fix it for themselves. Profi 2020 is proactive in a notoriously reactive industry. Most accounting firms, especially in dentistry, deal only with the past. Profi provides detailed reporting, growth-oriented advice, and dental-specific strategies to their clients to ensure that they are positioned for healthy long-term growth. On a personal note, I can definitely endorse Profi as my CPA firm of choice. And the 2 years that I've been with them have been the best in regards to organization and implementing advanced strategies to decrease my tax liability. If you'd like to get started or learn more, schedule your free financial x-ray and get half off the onboarding cost for being a listener of the Dentalpreneur Podcast. Just go to Profi, Profi 2020.com/DSI. That's Profi2020.com/DSI.
The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone, and welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. All right, guys, this is part 2 of my interview with Brannon Moncrief from dentaltransitions.com. One of the best summaries and explanations of the differences between a doctor-to-doctor transaction when you're selling your dental practice and a DSO/PE transaction when you're selling your dental practice. What are the strings that are typically attached when you're selling to a DSO, how a DSO valuation can differ from a doctor-to-doctor valuation, and what actually typically needs to be done and what is expected of the selling doctor if they are purchased by private equity/DSO. Great summary. Very, very knowledgeable guy that's been in the industry for 28 years, and he's seen just about everything. So if you haven't listened to part 1 of my interview with Brannon, make sure you go back and listen to part 1 first. It'll make a whole lot more sense, and then come back for this conclusion. Okay, guys, have a wonderful day. Enjoy the rest of this episode, and we'll talk to you soon. Maybe you could give us just a couple common scenarios as far as holdbacks and performance metrics that you have to maintain in order to get, say, withholding 20%, 30%. Maybe you can give us a couple of different scenarios that you're seeing with DSOs commonly these days.
Yeah, absolutely. So I think maybe the best thing to do is break it down by deal structure.
Okay.
There's 4 primary types of DSO buyers in the marketplace. You have, and I'll just throw out some names just because they're some of the biggest animals in the market that structure deals this way.
Okay.
So you have like the Heartland model, where they're going to buy 100% of the practice. They're going to give you 65 to 75% cash at close. And then they're going to have you stay on for, let's call it 3 years post-closing, and pay you out in 3 annual installments on whatever cash you didn't receive at close. That payment's not only going to be contingent upon you fulfilling your post-close employment agreement, it's also going to be contingent upon practice revenue maintaining where it was when they bought the practice. While it's important that you stay on, they also want to make sure that the practice continues to perform financially. Otherwise, they're not going to pay you that premium. So that's one type of buyer. The second type of buyer, and we'll call it kind of the MB2 model, because they're one of the first companies out there that started it, is the joint venture model, where they're going to buy 60 to 70% of your practice. They're going to give you that in cash at close, and you're going to retain 30 to 40% ownership within your own 4 walls at the practice level. You're going to get the management support of the DSO. You're going to get pro rata net income distributions associated with your retained JV equity ongoing post-close. And then you're going to have the opportunity to liquidate your JV equity at the next recap, typically in part. You can sell typically up to 50% of your remaining JV equity at each recapitalization event. Now, the cool thing about that, if it's structured properly, is you'll have tag-along rights with your DSO partner, where today your practice might be worth 6 times EBITDA, but when the DSO sells, they're worth 12, 13, 14 times EBITDA. Well, when you liquidate some of that JV equity at that recap event, you get the parent company multiple. So your retained equity in a JV structure essentially doubles in value overnight. Now, that comes with one caveat. Most smart DSOs out there that have a JV structure, there's going to be a base level of equity they want you to retain in your practice long term. So if you do a 70-30 deal at recap, you sell down your JV equity, you sell 50% of it. So you're retaining 15% equity in the practice. For most DSOs, they're going to require long term that you have 10 to 15% JV equity in your practice. So you no longer have the ability to participate in recapitalization events. When you're ready to step out of the practice, you have to sell that JV equity to another private party, another doctor. And that's going to be valued more like, a private party transaction. Mm-hmm. So you just have to understand that there's benefits, but you also have to identify, what is my potential exit going to look like from that JV equity when I'm ready to step away from that practice. So we've talked about the 100% practice sale Heartland model. We've talked about the 60-40, 70-30 JV MB2 style model. The third model out there is, and this is often done with, I would say, mid-level DSOs, call it anywhere from 25 locations to 75 locations, where they're going to buy 100% of your practice, and they're going to allow you to roll equity. So take, 20 to 30% of your practice sale, maybe less, and roll it into holding company equity. So rather than retaining equity at the practice level, a JV structure, you're going to actually take 30% of your proceeds from your practice sale and invest that in stock in the parent company. And
actually,
then you have
it's mandatory, right? It's not usually an option. It's usually mandatory to a certain percentage.
So typically it's mandatory to a certain percentage. I will say that I look at it this way. If they're loosey-goosey with their equity and they're saying, hey, you can roll as much as you want. You want to roll 100% of the practice sale into holding company equity? You can. I would be cautious about any buyer that's real loosey-goosey with their equity, because that's where the private equity company is making all their money, is on the recap and the sale of that equity.
Exactly.
So being protective of how much you can roll is actually showing that they value their equity. So we normally see, the really good DSOs out there that have this model, 10 to 20% is typically the max that they'll let you roll. But there is typically some requirement, and 10% is typically the minimum, with 20%, being the maximum with a lot of them.
So I'm sorry to interrupt, but
no, go ahead.
This is really, really a great breakdown. So you were saying one thing to be cautious of is if they are very, very loose about the amount of equity that you are allowed to purchase from them. That's number one. And I think maybe something that should be a consideration also is the strength and the history of the DSO, right? So you're saying if it's a mid-size and they have, say, 20 to 30 locations, but they've been doing this for 18 months and they've just been gobbling them up and there's not a whole lot of history there, there could be a significant amount of risk, especially if 30% of the revenue that should, or the sales price that should come back to you is mandatory to be reinvested. That could be a big risk.
It could. So in any investment, which is what this is, the roll into holding company stock is an investment. It's risk reward, right? Mm-hmm. So the smaller the company, the less history they have, the harder it is to do your diligence, mm-hmm. and the more risk there is. At the same time, potentially the higher the return on the equity. Yeah. So, and I'll relate it in this fashion. If I'm a DSO with 25 locations, mm-hmm. And I go from 25 locations to 100 locations before my next recap, there's a huge amount of arbitrage, a huge amount of financial return that's created in that level of growth. So I would expect as the investor that I may make, 5x on my investment. Now let's look at some of the larger DSOs. If I have 300 locations and you invest equity in me, I have likely a long history, multi-year history of performance. I've got probably robust infrastructure. It's highly unlikely that I'm going to fail. There's a lower level of risk there. And if I have 300 locations and I go from, so the last example was going from 25 locations to 100 locations, right? We added 75 locations. Yeah. Well, if I go from 300 locations to 75 locations, I've only grown by 25%, right? So in the other case, I grew by 4x, 400%. Mm-hmm. So I would expect as an investor, the larger the company, the lower the return, right? From a risk perspective, and you just can't create the same level of arbitrage, the same level of growth when you're already at 300 locations. One of the most important things to ask if you're doing an equity roll is, where are you at in the life cycle of the investment? Did you recap yesterday or did you recap 3 years ago? If you recapped yesterday, I would expect that I'm going to be buying the stock near par value. And you'll want to ask what that was. When you recap, the stock price essentially resets, typically to $1 a share. So I would expect that I'm going to be investing at par value and that my return is going to be significantly larger than if I'm coming into the investment 3 years after a recap, where there's maybe only 2 or 3 years left before a recap. Sorry about that.
No problem. And you said earlier that typically the recap time frame is between 5 and 7 years, correct?
That's correct. So gauging where they're at in their recap cycle and where that equity has been marked and asking them, all right, at this point in time, if I invest now, 2 years into your 5-year recap cycle, what are you projecting that my return on equity is going to be? And most companies will give you a projection. Now, there's a lot of factors that go into how that projection is made, and there are no guarantees. What I can tell you is, from a risk reward perspective, I don't know if there's a better place to put your money than private equity. And if you are, your practice is a part of that investment, you have some level of control and influence on the outcome.
Gotcha. Awesome. Very, very good summary. And then the fourth type.
So the fourth type is typically a hybrid. So there are some companies out there that will do, they'll buy, let's say, 85% of your practice. You're going to put the remaining 15% into a JV interest, a retained equity interest in your own four walls. And you're going to roll 15 of that 85% into holding company equity. So in that scenario, you have money in 3 buckets. You have the cash at close, you've got your JV equity at 15%, and then you've got the investment in the holding company equity at 15%. Mm-hmm. So that's why we call it a hybrid, because you don't have your money in one of two buckets. You have it in all three.
Right, right. So, when people are talking about this second bite of the apple, this recap, often they're promising that, your 30% that you're retaining is in 5 years is going to be worth more than your original sales price. Have you seen that to be the case in some of these recaps?
It's possible, but I think you need to take into account, how much equity can you sell at recap? Because
good point. Yeah.
In a lot of scenarios, you're not allowed to sell 100% of the equity at recap. You're typically allowed to sell somewhere around 50% of the equity. I will say in a JV equity model, you're likely going to be limited to selling less equity than you would in an equity roll model. In an equity roll model, oftentimes you're able to liquidate somewhere between 50 and 100% of the equity at recap.
Interesting. Yeah, you're teaching me something. I did not know that part.
So projecting what that equity is going to be worth at recap is not an exact science. And to think that there's no risk and that's a guarantee is a little naive. And of course, your buyer's not going to tell you that. So, as a sell-side advisor, we spend a tremendous amount of time vetting these buyers and advising our clients, hey, this is who this buyer is. This is their track record. This is what they've accomplished at each recap that they've hit, if they've even hit one. And this is where you're coming into the equity. This is where they're at their life cycle. This is what the equity is costing you. And these are the financial projections that they've given us. And then we stack up 5, 6, 7 offers and you evaluate across the board. Who do I like the best? What model is the best for me? What equity investment makes the most sense? Where am I going to get the most bang for my buck? And we've got to identify how risk averse is our client, right? Some people are, extremely risk averse and they want to go with a larger DSO where it's going to be a little bit, their return on equity might be a little muted, but it's more predictable, as opposed to betting on a smaller DSO where there's more risk, but the return on equity could be significantly higher.
Gotcha. All right. I want to make this episode evergreen and to last for years and for the information to be pertinent, 3 years from now, but that just seems to be impossible. Right now, I'd love to hear your take on what it is that DSOs are looking for. And well, let's start with that. And then I'm going to ask some questions specifically about how you interact between the seller and these DSOs. But let's start with my first question.
Yeah, absolutely. So, DSOs for the most part are funded by private equity.
Yeah.
Private equity is chasing yield. And there's really only two ways to get there. it's through consolidation, growth, and efficiencies, and through the accumulation of EBITDA. So EBITDA is what they're really in search for.
Okay.
So they're looking for practices with revenue in the, $1.2 million to $1.5 million plus, because that's really where you have to be in order to generate substantial EBITDA. Most practices with revenue under $1.2 million don't generate sufficient EBITDA to where the delta between the private buyer valuation and the DSO valuation will be significant enough for it to make sense for the seller to go the DSO route. So, sellers control part of what happens here. But as far as what the DSOs are looking for, typically practices revenue of $1.5 million and EBITDA of $250,000 plus.
Okay. So a good practice that's doing 1.5 is you're looking at 300 to 350, and EBITDA would be a good benchmark.
Yep.
That's a good efficient practice that's profitable.
A good efficient practice at $1.5 million is operating with a 20 to 25% EBITDA margin.
Yep. Okay.
Which would put you right there, that 300 to 350.
Okay.
And that's where, when you apply that multiple, that 5 or 6x, you start talking about selling for 150% of revenue, as opposed to that 80% of revenue in the private buyer market.
Yep.
So revenue is important, but efficiency and managing your overhead is even more important, because EBITDA at the end of the day is what matters. Yep. Most DSOs are looking for practices within a 60-mile radius of a major metro area. And a lot of that, there are some DSOs that tend to gravitate towards the tertiary markets, but recruiting is the biggest issue you run into when you're operating in those markets. So, most DSOs that are looking to grow rapidly, associate turnover and doctor recruiting is going to be one of the major headaches they deal with on a daily basis. If you're within 60 miles of a major metro area, it becomes a lot easier to solve that problem. They like larger facilities. So, 5 ops plus, ideally 8 ops plus, where you can have multiple providers. So, most DSOs would aspire to have at least 2 providers at each location.
Okay.
And the reason being is it's a delineation of, production responsibility and it mitigates risk when you have multiple providers. It also gives the potential for the practice to grow to a point where you can maximize EBITDA. If you're locked into 5 ops with no growth potential from a facility perspective, you're probably never going to get more than about $400,000 in EBITDA out of that location.
Mm-hmm. Yeah.
So location is important. EBITDA is important. Size of facility is important. And the story is important. Why are you selling? What is your plan post-closing? So most of the time, they're going to look for the primary producers and the owner to stay on for some period of time post-close. So if you wait until the day you're ready to sell and sail off into the sunset to look at a DSO option, the ship has probably sailed at that point. If you're not willing to stay on for at least a couple of years post-close, most DSOs are not going to be interested in your practice. Or if they are, they're going to dock the value for the transition risk that comes with you walking away at close. And your only buyers in that scenario will be somebody that already has a footprint in your area that can backfill your position with an associate that's maybe working down the street at one of their other offices.
Okay. So the follow-up question is, for those entrepreneurial dentists that have, say, a regional group, they have either one mega practice that's doing, say, $3 million, and they have a handful of providers, say 3 or 4 providers, versus a practice, say, they have taken the role of CEO and kind of hung up their clinical hat, and now they're managing 3 practices with a good EBITDA. Are they still attractive to DSOs if they're not willing to put the clinical hat back on? And how do the DSOs contend with that? Is it with associate contracts, et cetera?
Yeah, that's a fantastic question. Sometimes the hardest thing to solve for is the entrepreneurial dentist that stepped away from the chair and is looking to sell their practice to a DSO.
Right.
How do they fit into the transition?
Right.
Most of the time, the DSO is going to want them to stay on post-close, but then how are they compensated? Right. So most people gravitate towards a JV model or a hybrid model in that scenario so that they can continue to share in the EBITDA of the practice post-close.
Okay.
Because if you don't have JV equity and you're staying on post-close, but you don't work chair side, we've got to figure out how to compensate you. And that compensation is going to hit your EBITDA. Right. So all these things play together.
For instance, okay, I love this. I love your explanation here. This rarely comes up in interviews. So, and I've seen this happen before. Say, for instance, you are an entrepreneurial dentist. You're not doing clinical, but you have to get paid as, in one form or another, because they want you to stay.
Right.
So if your salary is going to be $100,000 per year, just for round numbers, it's probably going to be closer to 150 or 200. And they might balk at that, but your salary is going to be removed from the EBITDA. So you're actually going to be, basically removing sales money or the valuation money in exchange for your salary over the next 3 years, which people don't understand a lot of times.
Right. So, and there's nuances there that can potentially be negotiated, especially if the practice has the potential for growth, where, you may start off at a modest salary year one and then ramp it up as the practice grows so that we don't have to take the full hit on EBITDA, at close, because you're right. If you're not working chairside and you're going to make $200,000 a year post close, and we're selling for 7x, you just lost $1.4 million in value on the front end. We want to find a way to mitigate that. We want to find a way to put most of that money in your pocket and structure your post-closing comp to be creative and potentially start off modest and then grow with the growth of the practice. So a lot of that also comes down to, you got to create a competitive environment for your practice. Yeah. If you want leverage, you got to control the narrative regarding EBITDA, and you've got to have as many bidders at the table to create leverage so that you can negotiate the most favorable deal terms. And that, in that scenario, that is a major deal term.
It really is. I mean, if you think about it, just the example you used, if you're getting 7X and you're paying yourself 200,000, say it's a 3-year contract that you're needing to stay for, right? So you're getting $600,000 in salary in exchange for $1.4 million decrease in valuation. The math does not work out in your favor. That doesn't work. It does not work.
Yep.
That's an $800,000 swing or whatever the swing is. That's not good for the seller.
Right. And that's, these nuances we're talking about are where I think a lot of doctors get caught off guard when they take their practice to market on their own, or they respond to, some sort of mailer or a marketing piece from a DSO, and they start to get into these conversations. There's much more to talk about than just valuation. There are many deal terms to be negotiated, and they're oftentimes linked to each other. You pull one lever and it impacts another part of the transaction.
Got it. Okay. So I picture you, after speaking with you during this interview, as like the general manager of, say, the San Diego Chargers, who used to be my favorite team, and now I can't even look at them because they left San Diego. Now they're in LA, which was terrible because I was a 40-year fan and suffered for 40 years, and then one day, without even asking me, Brannon, they moved to LA. But anyway, I see you as like the general manager of a sports franchise, right? And somebody comes to you and they want to list their practice with you, and you have a Rolodex. And for you millennials, that was an old-fashioned thing where you used to put business cards and you'd actually roll it, not like a contact list on an iPhone, but an actual physical thing where you held business cards. So I picture you as like this general manager, and you're like, okay, this is a practice. I bet it would be great for this particular DSO. Is that the way your world works, or are you putting it out on the open market? How does it work from your perspective where you sit?
Yeah. So here's our approach. Our approach is, we take an educational approach. You come to me and you say, hey, I'm thinking about selling to a DSO. Mm-hmm. All right, let's start with why. Right? I want you to be intentional about why you're making this decision.
Okay.
Not that you just had a bad day or your buddy did it and you think it's a good idea.
I think all of us have gone through those days where we're like, that's it, I'm selling.
Yeah, absolutely. You pull the mailer out of the bottom of the drawer, and you give somebody a call, and before you know it, you sold the goose, prematurely. Yeah. So it's let's start with why. Let's be intentional in what we're doing. Uh-huh. Let's talk about your ideal scenario from a transition standpoint.
Okay.
Then let's talk about value. All right. Let's do a formal valuation. Let's figure out what your EBITDA is. And after you have all of that information in front of you, make a decision, an intentional decision. Okay. Yes, this is something I want to do. This is my preferred type of deal structure. This is my, am I looking for robust infrastructure and a heavy hand on the management side? Or do I just want somebody to allow me to take some chips off the table and leave me alone? Let me continue to run my practice the way I run it. Mm-hmm. And that will dictate how we market the practice. So in some scenarios, my clients say, show me everything. I want to see every type of deal structure out there. I want to talk to every buyer that you would think is legitimate and would be interested in my practice. Mm-hmm. In other scenarios, we're very specific. Hey, I want a JV deal structure. Okay, there may only be 4 or 5 buyers out there that are a fit for where you're at geographically, the size of practice, and that offer a JV deal structure.
Okay.
But our intent is to educate, allow you to make a conscious decision with all the information you need to do so. And then if you decide that the DSO strategy is the right transition strategy for you, we go execute. And what we do is create a very competitive environment, whether we're on open market and sending it to everybody, or I'm going through my Rolodex and picking up the phone and I'm calling 5 buyers. The reality is you only need a few buyers at the table to keep them honest, but you've got to create leverage through competition.
Right.
You should not be talking just to one buyer. That is a massive mistake on so many different levels, not only from a valuation perspective, but from a fit perspective and a deal structure perspective. If you're only talking to one, you have no leverage. And if you've met one DSO, you've met one DSO. They're all different in many different ways.
Yeah. Awesome. All right. So we've gotten to the point where I think it would be a great time to share your contact information. How do people engage with you? What's the process look like? Is there a discovery call first? Do you request documentation? How does it all work?
We always start just with the introductory call. I get to know them. They get to know me. We talk about what they're looking to accomplish. And from there, we typically move on to the valuation process. That's typically step one. That's where we get to know our clients and their practices a lot better. I'm really easy to get in touch with. I'll give my cell phone number. It's 512-660-8505. And my email address is Brannon. That's BRANNON at dentaltransitions.com. I respond to everybody within 24 hours. But, it's a soft sell approach with us. Really, again, we lead with education. I'm happy if they have questions about a deal they're already involved in, or they're interested in exploring their options and having us involved.
Awesome. Well, I gotta say, man, that was a power-packed episode. You have a really great natural way of explaining a very complex subject. I love the 4 different types of buyers. That I've never had anybody explain it that way to me before. So really appreciate your time and your clarity and the generosity of information. So thank you very much.
Absolutely. Appreciate you having me.
All right. So you guys don't hesitate to reach out to Brannon. I've known him for a few years. He's a good guy. He's one of the good ones. I didn't even get to get into some of the preconceived notions that our profession has with brokers, Brannon. But I will go ahead and say
I can imagine.
I will go ahead and say that he's one of the good ones, guys. So reach out if you have any questions about the sale of your dental practice or the eventual sale of your dental practice. That's it, buddy. Thank you so much for your time.
Yep, absolutely. Thank you.
All right, ladies and gentlemen, with Dental Transitions, Brannon Moncrief. This episode is being brought to you by the Dental Success Network. You all heard me say that my favorite part about going to meetings, conferences, and dental schools is talking with dentists and students about all aspects of dentistry. As you know, most connections and knowledge transfer happens after hours when we're just hanging out and having fun. The cool thing about DSN is that this collaboration has gone digital, and you can now get this high quality content without ever leaving the comfort of your home or office. DSN has members from all over the world, from startups to large groups, doing their best work and sharing what they've been able to accomplish in chat rooms like All Things Ortho, Dental Complications, Starting Up Right, Acquisitions and De Novo Secrets, Practice Management Like a Pro, Cosmetic Confidence, Endo Simplified, Social Media Mastery, Scaling Up Practice Strategies, Sleep Apnea and Airway, Implants, IV Sedation, Oral Surgery, and so much more. Additionally, we have one of the largest, most aggressive buying groups in the profession because our group's over 1,000 members have a collective revenue of well over $1 billion, which gives us the leverage to negotiate with any vendor, no matter how big or established. And finally, we've got a huge educational library with hundreds of instructional videos taught by our incredible clinical and business-focused faculty. If you want to join DSN, or maybe just take it for a test drive, check out dentalsuccessnetwork.com/free45 for a 45-day trial with absolutely no obligation. That's dentalsuccessnetwork.com/free45. Look forward to seeing you in the network. And that wraps it up for another episode of the Dentalpreneur Podcast. Look forward to reconnecting on the next episode.
Thank you so much for joining us today on the Dentalpreneur Podcast. Check out TrueDentalSuccess.com for full recaps of every show, a schedule of our live events, free video tutorials, and a whole host of practice-building resources.